Yes, dear students, in this session, we are going to have a discussion on Indian capital market. So, in the previous sessions, we have already seen that Indian capital market is part of Indian financial system, organized segment of Indian financial system, and as we know, Indian financial system have four components, that is the financial institutions, then financial market, financial instruments, and financial services. And financial market is one among these four components. And also we have seen this Indian financial market is subdivided into money market and capital market on the basis of the maturity of the instruments traded in this market. That is, the financial assets or instruments that are less having a maturity of less than 1 year or up to 1 year is traded in money market, or that constitute money market. And on the other hand, the financial assets or instruments that are having maturity of above 1 year, more than 1 year, constitutes the capital market. Okay, so thereby we can understand that this there is a distinct these are two different segments of financial market, that is this capital market and money market are two different segments of our financial market. And and we know there is different instruments in money market, like treasury bills, then money at call and stock notice, certificate of deposits, and all these are the instruments having maturity from few days to up to 1 year. And on the other end, we have instruments like equity shares, debentures, and all these bonds, and these are the different instruments that are part of capital market. And the difference of these instruments is that money market instruments like this treasury bills, call money or commercial bill, all these have only maturity having few days to 1 year. But on the other end, the equity shares, debentures, all these instruments have maturity of more than 1 year, and it may range from 1 year to 50, 20, 30 or 50 years. So that is a difference between the money market instruments and capital market instruments. And now we are going to discuss more about our capital market. So in this session, I will be we will be seeing about the various components or various instruments in capital market. So when we come to the capital markets, we know this capital market also have two segments, that is primary market and secondary market. And that also we know this primary market is a market where first time issue of capital market instruments take place, and the secondary market is the place where subsequent trading of capital market take place. So that is the difference between this primary market and secondary market in Indian capital market. Okay, now let us let that subdivision be there, that we will see later. But now we will see another kind of subdivision or another kind of classification of Indian capital market. Okay, so when we take this capital market, the capital market can be classified or subdivided on the basis of the instruments that are traded in the capital market. So in the Indian capital market, there are broadly two kinds of instruments or financial assets that are traded in Indian capital market. So these two kinds of instruments are government and industrial financial market segments or capital market segments. That is, the financial instruments or financial assets traded in Indian capital market are of two kinds, that is industrial securities and government securities. So actually, what is industrial security, or what are these industrial securities? Industrial securities means the securities that are issued by industries. Okay, that is, when some institutions, industries need money, or some companies need money for as capital, they will approach the market and they will raise money for their industrial purpose, and that kind of securities are industry securities. For example, if a company need 5 crore rupees as capital, that company can go to the capital market and issue, by means of issuing a shares through primary issue, can collect money from public, and that kind of issue, that kind of share issue is actually that segment is actually an industry securities, that equity share, that is an industry security, because it's the ownership security of that particular company, that industry. Okay, such kind of securities like the debentures are another kind of industry securities. Okay, so such kind of, that is securities that are issued by industries or companies can be called as these industry securities. And again, there are another kind of securities that are government securities. So as we know, why these people or industries or government, all these are issuing these securities, because they need money or capital. So likewise, a company want money, government also may be in need of money, and when the government need money, government will be also collecting or mobilizing fund from the public through the issue of certain long-term securities. So that securities market constitute the government securities market. That means, for example, if government of India need money for long-term infrastructure development, for example, government of India may be in need of 1000 crore rupees for construction of national highway, then National Highway Authority of India will be issuing bond, and by issuing bond, government of India will be collecting money or mobilizing money, and such kind of securities are known as government securities, because this National Highway Authority of India is part of government of India, and by means of this government of India bond, that is a 10-year bond, then government will be collecting money, and that is actually a government security. So this is the difference between industry securities and government securities. That is, industry securities will be issued by the industries, and on the other hand, the government securities will be issued by government. Okay. Now we are again going to the another classification about this industrial securities. Now we will see more about these industrial securities. So since there is no much discussion needed about this government securities, because government securities are actually bonds, and that is a common type of industry security. There is no there is no need for a elaborate discussion on these government securities, but we will see later in this chapter about government securities. For the time being, we will go to the discussion on industrial securities. So you just remember, we started the discussion from capital market. So capital market have two subdivisions, or on the basis of the instruments traded, that is the industrial security and government securities. And we have seen what is the difference between these industry securities and government securities. And now we will see what is again we can classify these industry securities into two types. That is, industry securities are of two types. That is the ownership securities and creditorship securities. So actually, ownership securities are actually the securities or instruments of offered or issued by industries, whereby the the person who gets this security will become the owner of that company. Such kind of securities are known as ownership securities. For example, equity shares. Equity share is an ownership security. So, if a person, for example, if I purchase a share of a company, so a company is an industry. So, if I purchase a share of a company, I am becoming the owner of that company. So, that is a peculiarity of an ownership security. I am the owner. I will become the owner of a company if I buy a share of that company. Buy the share of any company. Okay, so that is a peculiarity. For example, if I buy one share of Federal Bank, I am going to become the owner of Federal Bank. Okay, and similarly, if I buy the share of Tata Consultant Services, I am the owner of that TCS also. So this is the peculiarity of this ownership securities. Then again, there are another kind of industry securities. So industry security can be classified into another type, that is the creditorship securities. Creditorship securities means the securities that are issued by the companies or industries, and by buying or purchasing that securities, are going to become the creditor of that particular company. For example, debentures are creditorship securities. Debenture, that we know what is debenture. So if I buy the debenture of a company, for example, if a company like V-Guard Industries issue its debenture, and if I buy debenture of that V-Guard Industries, I am becoming the creditor of that company, of V-Guard Limited. So who is a debtor and who is a creditor, that we know. Debtor means one who owes money, and a creditor means one who how to get the money from, or one who is the person who how to get the money as a creditor. So when I buy, for example, when V-Guard Industries is in need of money, they can raise money by issuing 5-year or 10-year bond, debenture, 5-year or 10-year maturity debentures. And when I am, if a debenture costs rupees 1 lakh, and if I am purchasing that debenture by paying rupees 1 lakh, actually I am giving money 1 lakh rupees to V-Guard Industries, and V-Guard Industries is giving me an instrument, a written instrument, that the company owes money to me. That is, the company have to give me back that 1 lakh rupees after that maturity period, that is maybe 5-year or 10-year. So that is the kind of capital market instruments, that is a creditorship instruments. So remember, these are the two different types of industry securities, that is ownership securities and creditorship securities. That is the financial instruments issued by industries in Indian capital market are of two types, that is ownership securities and creditorship securities. Now we are going to the detailed discussion on this ownership securities first. So we have different types of ownership securities, and we will see one by one the different types of ownership securities. The most common type of ownership securities, or most prominent ownership securities issued by industries in India, are equity shares, that we have already discussed now. And there are different instruments like equity share, preference shares, and all these are different types of ownership security. So we will see one by one the different types of ownership securities. Then first of all, when we come to this equity share, what is an equity share? That we will see. So as we have seen, it's a ownership security, and it is issued by industries or companies to raise money. And we have already discussed about what is the capital. So we know what is capital. Capital is the amount that is required for a company to procure long-term fixed assets, and all these things we have seen. And actually, equity shares are the smallest unit of ownership of a company. The smallest unit of ownership of a company can be called as this equity shares. So if I actually the capital of a company is subdivided into small units, and that units are known as shares or equity shares. And by purchasing or by getting one such share of a company, a person becomes the owner of that company. So that is an equity share. And when we discuss about these equity shares, so when a company is in need of capital, that capital requirement may be for expansion, and for any other capital, large scale capital requirement, company may be in need of money. And at that time, company will go for issue of its shares. That is, issue of share means it will be becoming ready to sell its ownership and raise money. And how this ownership is sold, the smallest unit of its ownership is equity shares, and that equity shares will be sold out. That's a method of one of the method by which a company can raise fund for its capital need, to meet its capital need. And by purchasing the equity share of a company, a person is becoming its owner. And the other benefits that a equity shareholder can enjoy is that by becoming the owner of a company, he can, or becoming the shareholder, equity shareholder of a company, a shareholder can participate in the annual general body meeting of the company. That, and also an equity shareholder can vote in the will be having the voting right in the annual general meeting. And yet another thing is that the shareholders are entitled to get the shareholders are entitled to get the dividend. So dividend is actually the profit of the company. That's actually for example, if a company is making 1 lakh rupees net profit during a financial year, and if there are 1 lakh shareholders, if a company is having 1 lakh shareholders, and if a company is having 1 lakh rupees then as profit, then each shareholder will be getting rupees 1 as dividend, because that 1 lakh rupees net profit of rupees 1, or a divisible profit of rupees 1 lakh, will be divided among all the shareholders equally. Then one another thing is that these equity shareholders are actually eligible for the entire balance of profit. That is, after paying other external debts and other kind of shareholders, that is, there are different other categories of shareholders like preference shareholders. Then the amount that is left after paying all these categories of shareholders, the entire balance left is or can be claimed by the, or it's can be claimed by the equity shareholders. So that is a rights. That's actually this right to get dividend is a right for, and the right to participate in the annual general meeting is the right of a shareholder. And yet another thing that we should keep in mind regarding these equity shareholders is that actually these equity shareholders are also facing high risk also, because actually the equity shareholders will be paid back their fund only at the time of winding up of a company. This equity shareholders will be paid back their investment only after paying all other categories of investors. For example, so actually, if I am interested in a company's profile and I am investing rupees 1 lakh in the shares of a company, okay, then that is I am buying about 10,000 shares of a particular company. Let us imagine. Then and actually, when I invest or when I buy the share of a company, I am becoming the owner or equity shareholder, and I have the right to participate in annual general meeting, and I have the right to get the dividend. All these things are there. But if the things went wrong, and if the company become a loss making entity, and alas, if the company is going to wind up, then at that winding up time, the company will be repaying our company have to pay back all the money that he received from the owners or investors, and at that giving back time, the company will be giving the equity shareholders at the last. That is, after paying back the money owing that is owed to the bank and owed to other creditors and to the preference shares, and the money left after paying all these debts can be or will be paid to the equity shareholders. So that is the order of payment at the time of the winding up of a company. So hence, if a company is a loss-making entity, and if have accumulated losses, then the investors may lose the entire money that they have invested in a company. For example, if I invested rupees 1 lakh, or if I paid rupees 1 lakh to the company, if I gave 1 lakh rupees to the company as a capital, and if I got 10,000 shares of that company, but at the time of winding up or closing of the company, if there is nothing balance, there is no amount left after paying all the debts and all the preference shareholders, then I will not be going to get anything from the company. So I will be making a loss of rupees 1 lakh. That is, the entire money that I invested in that company will be lost for me. So that is the risk element is also there by investing in a company, in the share of a company. So that is a risk element in the equity share. So that's why this equity shares are also known as a risk capital. Okay, so that's a thing. That's about this equity shares. Again, we have different types of equity shares. So these equity shares are also of different types, and the prominent kinds of equity shares are equity shares with a detachable warrant. So the different and again another kind of equity share is the shares with differential voting rights. Then equity shares with non-voting voting shares or no voting rights. And another kind of equity share are set equity shares. So these are the different classifications of equity shares or different types of equity shares that are commonly issued by the companies. So let us see what are the these different types of equity shares. So as we know, the first one is equity shares with a detachable warrant. Actually, sometimes when a company issues shares, companies usually issue the shares with a detachable warrant. So what is a detachable warrant? That is it's actually a thing that can be detached. If, for example, from a notebook we can detach a paper. It's very easy for us. We usually detach paper, tear off paper from my notebook. So likewise, when a company issues a share, along with that equity share, companies give a detachable warrant, so that detachable warrant can be used to purchase another certain number of shares from the same company at a specific time. And sometimes these detachable warrants are also traded as a separate instrument also. So such kind of shares are known as equity shares, are known as shares with a detachable warrant. Actually, this detachable warrant will be giving the shareholder a specific right to purchase another kind of or another number of shares from the same company. So that is a peculiarity of detachable warrant. Then the another type of equity share is shares with differential voting rights. Usually, as we have already seen, these equity shares usually provide the equity shareholder with the right of voting in the annual general meeting. So actually, what is this annual general meeting that I have not discussed with you? So annual general meeting is the meeting or the time at which the entire activities for a particular financial year will be discussed with the shareholders, and at that time, at that meeting, the prominent decisions regarding a company will be taken through voting. So as we know, for a company, in the day-to-day activity of a company, the owners of a company does not have any voice, because the normal works of a company or the normal course of actions of a company are usually normal decisions of a company are usually taken by the board of directors and managing director. And in that normal business activities, the owners of the company does not have a big say. For example, in the case of Federal Bank Limited, Federal Bank is a company, banking company, and even if I have a share in the of Federal Bank with me, I will not be having the permission to go to the bank and tell the bank manager that I am the owner of the company. So you should the bank should function like this or like that. I will not be having the permission, or I will not have I won't be having the right to give instructions to the branch manager like that, because in the day-to-day functioning of a company, the owners or the shareholders of the company does not have any voice. But the shareholders will be having an voice or an opportunity to discuss and to instruct at the time of this annual general meeting. So the annual general meeting is the only time at which the shareholders of the company will get access to the business of the company and activities of the company, and it is a time where the shareholders can give instructions to the company, and that is a peculiarity of a company. So in the normal work course, the shareholders, actually shareholders, even if by purchasing one share of a company, you can or I can become the owner of a company, but I cannot exercise that ownership rights. Not right means power, because of becoming by purchasing one share. So only the ownership rights of a shareholder, that is a right to know about the company, know the working of the company, all these things can be exercised at the annual general meeting only. So in that annual general meeting, the company will be appointing its auditors or key people, and again the prominent decisions or by passing of resolutions, all these take place in the annual general meeting. So the annual general meeting is a very prominent one, and by means of voting, these decisions are usually taken. Voting means if 51% of the participants take a decision, that decision will be implemented in the company. Okay, that is a peculiarity. That is a by means of majority votes, the decisions will be taken in the annual general meeting. And at this annual general meeting itself, the decision to give dividend or all that kinds of prominent decisions will be taken in the annual general meeting. And here in this non-voting shares, now we were discussing about this. We were discussing about the shares with the differential voting rights. In differential voting rights case, actually, in this case, the shareholder will be given the right to vote more votes than the usual one. So that is the differential voting rights. That is, usually a shareholder will be having the right to vote one share equity shareholder will have the or we can vote one vote or cast one vote. But in the case of differential voting right case, the one shareholder, that is the owner of one equity share will have the right to cast more than one vote. That is, he may be given the right to cast 2 votes or 3 votes or 5 votes like that. So that is a differential voting right. Okay. That is more than normal number of voting right will be given for that kind of equity shareholders. That type of equity shares are known as a differential voting rights. Shares with differential voting rights. Now we are coming to the next type of equity share, that is a non-voting shares. So in certain cases, companies issue non-voting shares. Non-voting shares means that kind of shareholders or shares will not be having voting right in the annual general meeting. That is, so this in the normal course, a shareholder has the right to vote in the annual general meeting. But in the case of non-voting shares, that particular kind of shares or will not be having, or that shareholders will not be having the right to vote in the annual general meeting. Such kind of shares, that is that kind of shares, that is this non-voting shares, owners of non-voting shares will not be having the right to vote in the annual general meeting. And another type of equity share is sweat equity shares. Another common type of shares is a sweat equity shares. So sweat equity shares means the shares that are issued by the company to the people who are who actually sweat for the company or do hard work for the company, and actually it is actually given by a company to the certain employees or directors of a company who make much efforts for the company. So we know what is the meaning of the word sweat. Sweat means actually sweat comes from doing hard work. So when a particular employee or director of a company do hard work for the company or contribute much to the companies usually reward such contributions by giving shares to that director or employee at a discounted rate. And such kind of shares are known as this sweat equity shares. So these are the different types of equity shares. So we discussed about equity shares and its different types of equity shares. And now we are going to the next kind of ownership security, that is preference shares. So our discussion is regarding these ownership securities in Indian capital market, and that is ownership securities in the industrial security segment. We have ownership securities and credit securities, and one of the ownership security is this equity share. Another ownership security in industries are offered by industries are preference shares. So as the word denotes, preference shares are the shares which are as the instruments that by becoming the owner of this instrument, the person gets some preference over equity shareholders. Actually, equity shareholders are the people who are the owners of equity shares, and preference shareholders are the people who are the owners of preference shares of a company. And by becoming these preference shareholders of a company, that particular people will get some preference over the equity shareholders. So let us see what all are the preferences that are given to the preference shareholders. That is, first preference that is enjoyed by a preference shareholder is that he will get preference at the time of the dividend, payment of the dividend. That is, the preference shareholders will be given a fixed dividend at a predetermined rate. That is, usually in the case of an equity shareholders get the dividend on the basis of the profit earned by the company. That is, all the amount or the entire balance of profit that is available after paying external debtors and creditors, and the preference shareholders can be taken by the equity shareholders, that we have already seen. That is, if a company have a net divisible profit of rupees 1 lakh, net profit of rupees 1 lakh after paying all the creditors and all the preference shareholders, that rupees 1 lakh can be equally distributed among all the shareholders of the company. That is in the case of equity shares. But in the case of preference shares, if a company in the case of preference share, a preference shareholder have the right to get dividend at a fixed predetermined rate. That is, even if a company make rupees 1 lakh as net profit, or rupees 2 lakh, or rupees 10 lakh, or 1 crore, the preference shareholder will be getting a fixed dividend. So that fixed dividend will be predetermined, and it will be determined in a earlier course. But the preference shareholder will be getting a fixed dividend only. That is the peculiarity of preference shares. But in the case of equity shares, the dividend varies according to the profit earned by a company. That is, if a company earns 2 lakh, let us assume in the case of equity shares, if a company is having 1 lakh shareholders, and if a company make 2 lakh net profit, that is, if a company have 2 lakh rupees as net profit, that 2 lakh rupees can be divided among 1 lakh shareholders. That is, each shareholder will get rupees 2. Each shareholder will get rupees 2 as dividend. Again, if a company makes rupees 10 lakh as net profit, and if there are 1 lakh shareholders, each shareholder will get rupees 10 as dividend. Again, if a company make 50 lakh rupees as net profit, and if there are 1 lakh shareholder, each shareholder will get rupees 50 as a dividend. So actually, the dividend of an equity shareholder, dividend that is to be received by an equity shareholder, depends on the profit that is made by the company. But in the case of a preference shareholder, the dividend is fixed. That is, it may be it will be fixed at the time of issue of this preference shares. For example, if the preference shares are having a fixed dividend of rupees 10, that is, if rupees 10 is the dividend fixed, then that preference shareholder will be getting rupees 10 as the dividend every year without any change. That is, if a company makes rupees 1 crore as profit, or if a company makes 10 crore as profit, the dividend, the preference shareholder will be getting the same dividend rupees 10 itself. There will not be any change in the amount of dividend that a preference shareholder receives, because the dividend is fixed in advance. And even if a company does not make any profit, then also the dividend has to be paid for the preference shareholder. Okay, that is, if a company is not at all making a profit, then also the company have to pay dividend to the preference shareholder at the predetermined rate. But we know in the case of an equity shareholder, the company need not pay anything to the equity shareholder if the company is not making any profit. But it is not. But the case is different in the case of preference shareholder. We know. Okay, so in the case of equity shareholder, company have to pay dividend only if the company make profit, and the proportion of the profit will be given to the equity shareholder as dividend. But in the case of a preference shareholder, the company will have to pay dividend even if the company is not making any profit, and also the dividend is fixed. There will not be any change. If whatever be the profit, the dividend will be fixed in advance. So that is a peculiarity of a preference share. So, and again, why this preference shares are known as preference shares? Why the name preference comes? Because one important thing is that the preference shareholders are given preference at the payment of dividend. That is, before paying dividend to the equity shareholder, the companies will give dividend to the preference shareholder. So that is, after paying the preference shareholders only, the equity shareholders will be given the dividend. Again, one more thing is there, one more area of preference is there for a preference shareholder, that is at the time of winding up of a company. That is, if a company is at the time of winding up, that at the time of winding up or closing up the company, that is, if a company is continuously making loss or because of any other reason, the company is to be winding up is to be done, then at the time of winding up also, the preference shareholders will be given their investment back prior to the equity shareholders. That is, only after giving back the investments of the preference shareholders, the investments of the equity shareholders will be given back. For example, if I purchased rupees if I give, if I purchase 10,000 shares of a particular company by paying rupees 1 lakh as capital to the company, and if the company failed and company is going to be closed, then at the time of winding up, if I am the preference shareholder, company will give back the money that I invested or that I gave to the company before giving back the investments back to the equity shareholder. So that is the case of the preference shareholders. That is, the companies have to give back the entire investments of the preference shareholders prior to giving back the investments of the equity shareholder. So there also preference shareholders are given a preference over equity shareholders. So that's why these preference shares are actually known as this preference shares. Okay. So there are also different types of preference shares. So the commonly known common preference shares are actually redeemable preference shares and irredeemable preference share, convertible preference shares, then participating preference shares, then cumulative preference share, and again preference shares with warrants and fully convertible cumulative preference shares. So these are the different types of preference shares that are now commonly issued by the companies. So we will see one by one about the different types of preference shares. So first one is redeemable preference share. Redeemable preference share means the preference share that is issued by the company will be having a particular maturity, and after that maturity period it will be redeemed. Redeemed means, for example, I will tell you, if I purchased 10,000 preference share of a particular company, for example V-Guard Limited, by giving rupees 1 lakh to that company, that is I purchased rupees 1 lakh, I purchased 10,000 shares of a company by giving rupees 1 lakh, or investing rupees 1 lakh in V-Guard Limited. Then if that equity share, if that preference share is a preference share, then that is redeemable preference share. If that preference share of V-Guard Limited is a redeemable preference share, then with the maturity of 10 years, then V-Guard Limited will give back me the rupees 1 lakh that I invested in or that I gave to V-Guard Limited after 10 years, because that preference share is redeemable after 10 years. That is, it's a redeemable preference share that is to be redeemed after 10 years. So redemption means giving back the money that I gave to the company. So here I gave rupees 1 lakh to V-Guard Limited, and I got 10,000 share of preference share of V-Guard Limited, and since that preference share is a redeemable preference share, V-Guard will be giving me back the amount that I invested in V-Guard Limited after 1 lakh after 10 years. And 10 year means because its maturity period is 10 years, it will be given back after 10 years, and up to that 10 year I will be getting dividend, preferential dividend every year. Okay, but this, since the peculiarity of this redeemable preference share is that it can be redeemed. Redeem means giving back the investment, or it's actually the redemption period is the maturity period of the instrument. That is, after that period, that instrument will not be there. That is, that money will be money that I invested in V-Guard will be given back to me at the time of that redemption. Okay, that is a redemption process, and these are the redeemable preference shares. Then next type of preference shares are irredeemable preference shares. Irredeemable preference share means that kind of preference share cannot be redeemed. That is, that shares will be always there. The company cannot take back the shares, irredeemable preference shares once issued. That is, once the irredeemable preference shares are issued, that preference shares will be there as long as the company is there. That is, company cannot close, or there will not be any maturity for the irredeemable preference shares. That the company will, once an irredeemable preference share is issued, it will be there for the lifetime of the company. So such type of preference shares are known as irredeemable preference shares. That is, once if for example, if you take example like this, if a V-Guard Limited issued an irredeemable preference share and I gave rupees 1 lakh to V-Guard Limited and purchased 10,000 irredeemable preference shares from V-Guard Limited, that irredeemable preference share will be there as long as the company is there. That is, I cannot, that V-Guard Limited will not give back that 1 lakh rupees that is bought from me, because it's an irredeemable preference share. Okay. So that's a irredeemable preference share. Now next is another type of preference shares is a convertible preference share. Convertible preference share means preference shares that can be converted into equity shares. So that type of preference shares are known as a convertible. That can be the preference shares that will be converted into equity shares in a future period are known as a convertible preference shares. Then there is a participating preference shares. So we have already seen in the case of equity share, equity shareholders get full amount that is distributed or available after paying the external debts and preference shares. That is, for example, if a company makes rupees 1 lakh rupees net profit, if a company makes rupees 2 lakh as net profit, and after rupees 50,000 rupees was paid to the bank as interest, if there was an interest of rupees 50,000 that was paid out of the net profit, and there was another number of preference shareholders, and that preference shareholders were given rupees 50,000 as dividend, and there is at last, after paying all these debts, there is 1 lakh rupees as the divisible profit for equity shareholders, and that rupees 1 lakh will be divided among the equity shareholders. So here we know, in the case of preference shares, normally their dividend is fixed, and there is no, or the preference shareholders will not have any claim over the balance amount after all this. Okay, but in the case of these participating preference shares, they will be having the right to participate in the profit more than the fixed dividend. So such type of preference shares are known as participating preference shares. That is, this participating preference shareholders will be having the right to get dividend, fixed dividend, plus a participation in the profit that the company makes. So such type of preference shares are known as participating preference shares. The next is a cumulative preference shares. Cumulative preference share means if in a particular year, if a company is not making profit, and if the preference shareholder does not get money from the company as dividend, that money will accumulate. And in the future period, if the company makes, for example, in the next year, when the company makes profit, that in that year, the accumulated dividend can be claimed by the preference shareholder. For example, let us assume V-Guard Limited have some preference shareholders, and in the previous financial year, V-Guard Limited was not making any profit, and therefore because of that, V-Guard Limited was not able to pay anything to the preference shareholders due to the financial crisis due to COVID. But in current financial year, if V-Guard Limited made enough profit, then if the preference share is a cumulative preference share, then V-Guard Limited have to pay the dividend of previous year along with this year's dividend. So the preference shareholder will get the dividend of 2 years in this current financial year, since that preference share is a cumulative preference share. That is, the dividend that is payable will accumulate every year, and even if the company is not able to pay the dividend this year, it have to pay it in the next year. So that is a accumulation process, and that is cumulative preference shares. The next is the preference shares with warrants. So already we see about the equity shares with the detachable warrant. Similarly, companies issue preference shares with warrants, and by means of this warrants, the company can buy the shares of a company at a future period at a predetermined price by means of these warrants. That is, when a company issue a preference share, company will be issuing the preference share along with a warrant, and by means of that warrant, getting that warrant holder can go to the company and get the shares of the company at a predetermined price in a future period. So that is a preference shares with warrants. The next is a fully convertible cumulative preference shares. That is a preference share that is having all the features of the cumulative feature, and along with the convertibility feature is known as a fully convertible cumulative preference shares. That is a preference share that is issued by a company with the feature of convertibility and cumulativeness. Such kind of preference shares are known as cumulative preference shares. That is, the preference share will be cumulative in nature. That is, even if a company is not able to pay the dividend in a particular year, that will get accumulated and it will be payable in the next year. Also, it will be convertible also. Convertible means in the future period, the preference share will be converted into equity share, and such kind of shares are known as a fully convertible cumulative preference shares. So with that, we are coming to the end of the ownership securities in Indian capital market. We are concluding the ownership securities. So in the next class, we will discuss about the creditorship securities in Indian capital market. So we started the discussion in this session with the capital market, and there are two types of instruments in capital market. That is the government securities and industry securities, and we discussed about the industry securities now. That is, industry securities are of two types. That is ownership securities and creditorship securities, and we have completed the discussion regarding the ownership securities in industrial area segment. That is equity share and preference share. So in the next class, we will see about the creditorship securities, that is the debentures and bonds. So thank you.